We're starting to see the reaction in the markets. The S&P 500 down for 7 straight sessions, longest losing streak in 5 years. Joining me right now is the Wall Street Journal's chief economics correspondent, John Hilsenrath, along with Korn Ferry Vice Chairman Alan Guarino. Good to see you both, gentlemen. Thank you so much for joining us.
Great to be here.
John, what do you make of these moves? Is the market reacting to the uncertainty of the election?
I think it certainly is. The investors don't like uncertainty. It looked like a week or two ago Hillary had this thing in the bag, and now it's not at all clear that she does, and I think markets are pricing that in by selling off.
And Alan, the broader story of the economy is not great. We've got the jobs number out tomorrow, although we did get a pretty good GDP number last week.
Good GDP number. The jobs situation has been sort of a stealth weak recovery. It creates this image that we have low unemployment, which is true, but we've had the worst wage growth among the G20 post this recession. And if you look at Korn Ferry's Hay Group data, you'll find that on an inflation-adjusted basis, people are actually making less money today than they did pre-recession.
Wow.
Yeah, I've seen that data go all the way back into the early 80s where people are making less money now. But I think the biggest thing we have after the election is the Fed. And, you know, in December, do we get a rate hike? And if we do, what happens? If you remember last year into January, the market had a huge sell-off when the Fed hiked just 1/4 of a point. So if we're definitely getting a rate hike, what effect does that have on the market?
Well, you know, we've actually recruited 2 Fed presidents over the last decade.
That's right. Pat Harker's your latest one, right?
Exactly. And so it's a double mandate, right? Inflation, they have to protect us from inflation, and they have to promote job growth. Well, job growth looks good if you look at the headline number. But the fact of the matter is inflation is driven by people spending lots of money because they're highly employed. The numbers don't bear that out. We have some charts that will show you that we are at a very weak level of wage recovery. So, yes, they're going to work, but they don't have a lot of spending power. So where do we get inflation?
Right, right.
You know, one of the points I'd like to make about the Fed is this cycle this year is a little bit different than last year. We had a huge run-up in the dollar going into last year's rate increase, and we had a lot of turbulence in China. This time around, I think markets have figured it out that the Fed is going to do one, but they're not going to do a lot after that. And as a result, I mean, the dollar's a little bit stronger than it was a few months ago, but not that much. It's pretty stable, and we're not hearing a lot of noise out of China right now, which I think suggests that the markets have priced this in. I think they can digest a rate increase by the Fed in December.
John, did you hear anything yesterday from the Fed? Obviously, they left interest rates unchanged. We were expecting that. Janet Yellen said that a raise in rates is likely before the end of the year, so we were expecting that as well. What was your takeaway from what we heard yesterday from the Fed 2-day meeting?
Well, the one thing that really struck me is that they're starting to see glimmerings of inflation picking up. You know, inflation has been below their target for 53 straight months, almost 5 years going now, and they're starting to see some signs that it's picking up, and that's another reason why they want to move. So there were several references in their statements to seeing a little bit of inflation out there, and that might lead to the kind of wage growth that we're saying has been missing, and certainly has been missing in this expansion.
I wanted to point out something. It was a note I got from Sam Stovall yesterday at S&P that the S&P 500 was down 2.2% in the 3 months prior to October 31st. So from July through October, from late July through October, which implies a Republican victory this election cycle.
Wow.
Because if you go back and look since 1944, the S&P has fallen during those three months, and the incumbent person or party has been replaced 86% of the time. There was only one exception in '56 during the Suez Canal crisis. But I just thought that was really interesting. And they don't think, S&P does not think that a Trump victory is factored into the markets at this point, and they do expect to sell off. If he wants to do well next week.
I think you got to throw out a lot of those metrics and predictors of, you know, of who's going to win this election, because this whole election cycle has been so unpredictable. You know, a year ago, who would have said that Donald Trump would have been the nominee? Who would have said that these email revelations would have come out, and FBI reviewing its investigation a week before the election? I just think, you know, you look at these stock market predictors, and it's just very hard to hang much on them right now.
Yeah, I agree. I just thought it was interesting.
It is.
Hey, John, it's Mike Murphy. I have a question. Since this rally really began, we talked about what's you know, bad news is actually good news. Bad economic news means lower rates for longer, which is good for the stock market, so you can keep buying without any sort of major correction. If the Fed's going to raise and has to raise, and that's in the face of not great or not very strong economic data, I think that is the worst setup for the stock market. Can you speak to that?
Well, you know, I actually would take a slightly different spin on that. You know, I think in this case the market has priced in that the Fed is moving, and the Fed has been very, very deliberate about saying that they're not going to do much after that. So I think we could, when we see good, if we see good jobs numbers tomorrow,
yeah,
I think that the market will take that in stride in terms of the Fed and say, hey, maybe this economy is finally starting to grow a little bit faster.
So the estimate's 175,000 jobs created in the month of October. The unemployment rate expected to go to 4.9%. Alan, you're in the thick of things every day. You're placing people in white-collar jobs, and you really get a good sense of how things feel. Characterize the jobs picture for us right now.
I think, as I've said in the past, we're in a new normal situation. So we don't have a big, powerful, robust job market, but we don't have a declining job market either. So I think it's sort of steady as you go.
Yeah.
I think 175 is safe. I think 200,000 to the upside and surprise is potentially possible. But I think it's this sort of, you know, steady kind of very shallow growth as we move forward in terms of non-farm payroll.
But when you place people in jobs, where do you see the opportunities? What areas?
Yeah, so interesting. So first of all, for the first time probably in the last, since the recovery, large corporates are doing more hiring than small and mid-sized businesses. So that speaks well for potential wage growth, because big companies tend to pay more than smaller companies, the kind of folks they hire. So that's one thing.
What, like consulting, lawyers, what?
Well, and then in terms of the industries,
yeah,
consulting, lawyers, and so on and so forth, professional services, leisure and hospitality, interesting, and healthcare. Energy, still bouncing along, having a hard time.
And mining has been shedding jobs now for a long time, mining and manufacturing as well. John Hilsenrath, Alan Guarino, good to see you both.
Thanks.
Thank you so much, gentlemen.